are going to talk about the SEC side of the syndication process and what that means for you as an operator, a passive investor, syndicator, whatever. So, with that said, the man who asks all the questions all the time the right way, Ryan Gibson, Chief Investment Officer of Spartan Investment Group.
Thanks, Ben.
Thank you.
Thank you. So, how many people here are raising money for their deals? Great. Keep those hands up. How many people are investing in other sponsors' deals? Okay. And how many people would like to invest in a deal or create a syndication for somebody else? Okay, so everybody's on the same page. I like that. So without further ado, Roland Wiederanders is with me today. He is an SEC attorney, and he's going to talk about the legal questions that you have that typically come up in syndications. And before we get into the discussion, what I wanted to say is I heard something at lunch or breakfast maybe that concerned me a little bit. And I heard that I don't really care about the SEC legal stuff. I leave that up to my attorney. And I just wanted to emphasize that the raise process starts before you even engage an SEC attorney, depending on how you're going to raise funds. So I think this conversation, while it might be boring, will be very appropriate to your syndication business starting today. So without further ado, Roland, my first question is take us through when this SEC law started and a little bit of a history and background in it.
Yeah, the year of the act is really significant. If you think about it, it's the Securities Act of 1933 and what was going on. In 1933 was the Great Depression and signaled, it started really in 1929, but this was really a Consumer Protection Act that was enacted, and generally it requires all securities to be registered, to be public companies. But along with that, it creates all these exemptions that we work within to syndicate deals, to finance investments.
Excellent. So another question that I had from the group earlier was, what are these exemptions used to raise money for?
That's a really good question, because I remember somebody said you can't use a 506B for multifamily, or maybe it was the opposite. But I like talking about this because in my practice, I help people raise money for all types of things. I've got one of my very best clients has an innovative design for an electrical motor. And so I've learned a lot about that industry. But I'm passionate about the real estate industry for some specific reasons. And it's just, the question is, yes, you can use these exemptions to raise money for any legal venture. Nothing illegal.
So self-storage, multifamily, RV parks, mobile homes, and a friend's business that may be unreal estate related.
Yeah, absolutely.
All fall under these exemptions.
That's right.
That's great. So one of the things that are commonly that come up, and I apologize if there are folks in the crowd not familiar with the 506B and C, but there's endless debates on what's better, 506B or 506C. Why does 90% of all Reg D offerings fall under 506B?
Yeah, that's a really good question. And as we were preparing for this, it was interesting to look at all this data about this. But I think that the real answer is you're able to use advertising with 506C, and that sounds like a really great thing, but it comes with a burden of verifying the status of all your accredited investors with third-party data. And of course, you can't accept any non-accredited money in those deals. And then you combine all that. Well, also you completely lose the exemption if you fail to verify the investor's status as being accredited. So that's a really bad result. And you look at the flip side with a 506B, you think, well, gosh, I can't use that advertising. But as I think we'll get to in a second, it's really pretty easy to establish that pre-existing substantive relationship so that you can basically have advertising as long as you put it all behind a password-protected site.
Great. So that's kind of what brings me to the here and now. So the 506B is the most commonly used exemption under Reg D, and that requires everybody to have a pre-existing relationship. So as folks are establishing those pre-existing relationships, what defines that?
Part of it's passage of time. You know, it can't be an instantaneous thing. Hi, you know, it's good to meet you, Ryan, and you know, immediately here's the offering document.
So what if I just met somebody out in the lobby here today? Can they invest in my next project?
Well, potentially. And what I would tell them, you know, I always like to be upfront with people and tell them the reason behind. You know, the SEC has rules about me being able to make an offer of securities to you using the exemption that I'm relying on. So we have to establish this pre-existing substantive relationship. So it's really great to meet you today. I'd like to get your contact information, send you a questionnaire, qualify you as either being accredited or sophisticated. We can maybe talk about that. But then allow some passage of time, get that response from them, and then enter into, you know, have some more dialogue so that you can really say that you've also had a substantive relationship so that you really can evaluate this person. And, you know, I can't emphasize enough that knowing your investors is something that's really important to have a successful offering and avoid liability.
Absolutely. So one thing that we've done in the past is we actually, going along with Joe Fairless's presentation about wanting to build relationships, and his meetups, he likes to have education, and he also likes to have relationship building. So one of the things that we've done is we've actually hosted happy hours for investors, and we do all of our solicitations under 506B generally. And we invite people that we don't know to these happy hours, and we give a presentation about self-storage investing. And we also have a happy hour session where we can actually solidify those relationships. Talk me through what I can say in that presentation when I'm introducing my company to somebody for the first time, and what I can and cannot say.
Yeah, this is really, really key. You know, you can make factual statements about yourself, and the one thing that you have to avoid, though, is making any statement that might, there's some specific language that the SEC uses, but it's like condition the market or incite investor interest. And you know, a real good example is if I, well, it's just, you have to be really careful with the language and you know, multifamily investment opportunities. That would probably constitute an offer, even though that's a factual statement. But
so what if I'm up on stage and somebody asks me, you know, a question when I'm in front of the entire group, and they say, what is your average return to your investors based on your history? Can I answer that directly?
Yeah, you can give information about your historical performance as long as there's nothing there that's going to invite them or you know, it's purely a statement about your history, your past.
Absolutely.
But just, you know, when you're talking about that, I couldn't emphasize enough being careful and maybe, you know, waiting to give all the information. But, you know, it's you know, something to be careful with.
So what I'm hearing you say is it's all about building a relationship with somebody and learning what they're interested in for investing, and that can kind of help in the sales process and bringing them in because you're interested in what they're doing. But then you're also learning about that investor, and you're documenting what that investor may be interested in, and that's helping that relationship.
Yeah, definitely, and getting an idea of who this person is, and it's hard to determine somebody's reasonableness, you know, down the road where everything's gone to hell. That's really where you know, the people get angry and they sue to make a point. So it's hard to gauge that, but if you're dealing with people that have a real balanced, you know, a long history of investing in private deals, they understand the limited, you know, transferability, and they understand the asset class. And you know, the good thing is they're going into something that's relatively safe, but it is a good idea to get to know your investors, definitely.
Gotcha. So I've heard this kind of reoccurring theme that I started raising money for a deal, and we did the deal and everything was great. And I did a syndication, and I didn't even realize I did a syndication. So talk to me about that. You know, if you did, you know, or let's say somebody were to raise something, you know, a small raise like $400,000, and they had their friends and family, or maybe it's just you know, their mother or their father that invest. talk to me about what they need to do. Do I have to file paperwork for that? Do I have to go through this whole long process and hire attorneys and spend the money on the solicitation and things like that?
You know, the good news is you're probably okay. You know, we talked a little bit about like if your mom invests with you, unless you know, if my mom invested with me and I lied and defrauded her, she might sue me over that. But if I go to her and say, Mom, you know, I took your investment money and did my best, but somebody stole it, or whatever circumstances were, she wouldn't come back around in the end and sue me. So if you have, I mean, that's kind of one answer, is that you have a relationship, a close relationship like that. And it may be that you haven't even sold securities, depending on you know, what it is that you've done, you know, if you're borrowing money. But a close friends and family round where you know all the people and they've got this really close relationship where you know that they understand everything that's going on. And of course, documenting things in a company agreement and a partnership agreement, making sure that that's covered. But it's really possible to conduct an offering of securities without an offering memorandum. I wouldn't advise it. And somebody asked me this at lunch, you know, what's the threshold? And I guess really the threshold is if the deal goes to hell, you know, what size check are you willing to write somebody a return of their investment, because a potential remedy is rescission.
So it sounds like the syndication, the documents are not, they're protecting the investor, but they're really protecting the operator in a lot of respects.
Yeah, and I joke with people, that I made this joke at lunch, I apologize for repeating myself, but I'm kind of a life insurance salesman in the sense that nobody's going to read the policy until the patient dies.
Good point. So, so let's talk about, I've got a question in the WUVA app about getting paid commissions to raise money for other friends and things like that. So I'm not a registered investment advisor or a broker dealer. Can I get paid a commission to raise money for another sponsor?
You know, we prepare for this, and the answer is no. But there's more to it than that.
Sure.
So.
Talk about your history providing general counsel for hedge funds and kind of what you were able to do and things like that.
Yeah, and this is really instructive because understanding that world, I worked for an SEC registered investment advisor for 3 years, and we were a fund of hedge funds. And so the revenue model there is 1.5 and 20, 1.5% of assets under management and 20% of profits. And they're investing in public securities, equities, stocks, things like that, not real estate. But the model there is such, and there's actually even a disclosure rule in the Investment Advisors Act that you can work with sub-advisors, other investment advisors who are going to be bringing you investors to the fund. And in exchange for that, they're going to be serving kind of as a subcontractor investor relations person for you. And to compensate them, they're going to be doing work. Their friends, their clients are going to be calling them first instead of you. And the way that they're going to be compensated there is that they're going to get 50 basis points from the 1.5% assets under management fee. And so it's a legitimate model in the investment advisor world, and we're not all registered as investment advisors. It's something that I think everybody should be thinking about, particularly if you combine multiple assets in a single fund. But it is a model, a compensation model that I think that can be applied here that's reasonable, and it really does reflect this reality that if you're out there, if you're partnering, and we should talk about that as well, if you have people helping you raise money and they're your partners, they're going to be with you for the life of the deal. The investors that they bring to you are going to be calling them first, ideally instead of you. That's how you want to set it up. And they should be compensated for that. It's the upfront compensation, that we started out off talking about, that really is so dangerous.
Yeah, and I think most of the folks that raise money for other deals are becoming part of the GP. So that's kind of speak to that and how that gets split up and how an aspiring syndicator can do that for somebody else's project, or how syndicators right now are doing that for other operators in the present. And what the operator needs to know about the relationship and how to attract a syndicator to be part of their GP so they can get funds for that project.
Yeah, and I think, we mentioned it, is that partnership relationship, understanding that we're in this together, and part of the value that you're adding is attracting that investor to the deal, but really it's going to be that ongoing, investor relations services that you're going to be rendering to me that I don't have to do myself.
Sure.
I don't feel like I answered everything,
no, that's
though.
Great.
But
no, that's good. Good, it makes sense. Yeah, so we hear a lot of 506B, a lot of 506C. How many are raising under 506B? Okay, so 25%. How many are doing it under C? Okay, not very many. Hi, Kathy Rich. And what about, do we have any 504 solicitations? Okay, any Reg A's in the room? Okay, so generally we are following what the statistics are for raises, which are 90% come under 506B, and the 506C that we talked about. We always hear about 506B and C, and I think everybody in the room knows 506B, pre-existing relationship, sophisticated and accredited investors, only that you can have up to 35 non-accredited investors, and we talked ad nauseum about the relationship. 506C is accredited only. You can advertise, but you have to go through the third-party verification, which if you're investors, if you've been going under 506B and building all those personal relationships, when you do the hard shift and go to C and advertise, now your investors have to do all this third-party accreditation, and they have to be kind of acclimated to that, which can be stressful on your investor network, right? Or maybe you've already planted that seed from the beginning. But let's talk about what else is there, because it seems like those are the only two solicitations that are spoken about. So what else do we have available to us?
And just to draw back, there's a reason for why 506 is so widely used, and it's federal preemption. And it's a really important concept because in the past, each state would have its own securities law regime, so you would comply with the SEC rules, but then also you would have to comply with the rules of each state. And in 1996, there was a Standardization Act that basically said, the end result of it was that Rule 506 offerings, if you do that, all a state can make you do is file a copy of the Form D and pay a fee to the state, and it's about $200 or $300 per state. So that's a really important concept to understand why 506 is so widely used.
Good point.
Going on to Rule 504 is something that maybe is more useful. It's another exemption, but it doesn't have that corresponding state preemption. And so if you do a 504 offering relying on that at the federal level, you are going to have to look at the laws of each state. And most states do have a corresponding exemption. 504 was made a lot more useful a couple years ago in connection with the Jobs Act. It was increased. The maximum that you could raise under that went from $1 million to $5 million. And so it is a viable option, but I would just say that be real careful about the laws of the states where your investors reside, because you have to pay attention to those.
Why is 504 better than 506B?
It allows for non-accredited investors, really an unlimited number of non-accredited investors. And there's also there's a technical requirement in 506B that if you let in non-accredited investors, you need to get your balance sheet audited.
How much does that cost?
5 to 10 a year.
Okay, so if I'm an accredited investor investing in a 506B, and I have awareness that there's other non-accredited investors in that, the project is being burdened by that $10,000, potentially that $10,000 a year auditing expense. Interesting.
Yeah,
Okay.
and I love hearing feedback from the marketplace, and I do want to point out that you had advice from somebody, a viable securities lawyer that said that maybe that's not really a requirement. I mean, I can pull the rule out and show you the language, but it is kind of a weird thing, and I know that people do offerings all the time and don't get their balance sheet audited, but it's a technical requirement. With 504, you wouldn't have to do that, but
Sure.
It's just something to talk with somebody like me about, and I'll do my best to steer you in the way that's most efficient, really. And just the market tells us with the statistics, it really still is 506B. Over 90% of offerings rely on that exemption.
Let's talk about Reg A really quick.
Sure.
What is Reg A? How much does it cost? And what benefits does it provide? And what are some of the downsides as well?
Regulation A was it's a mini IPO, so it's very similar to like what you would go through if you wanted to take your company public, but it's sort of a scaled back version of that. And a lot of people are using it now to create REITs that would be totally applicable, useful for what we're talking about here. You do go through this registration process with the SEC, so there's a little back and forth. The data that I saw recently, it's average 78 days. You're going to be paying a little more in legal expenses, probably $50,000 to $75,000 versus maybe like, I heard a number 25 for a 506B. I can do it for less. And then the important thing about Reg A, it allows you to raise up to $50 million, and you can use advertising, and you can take money from non-accredited investors, and minimums as low as $2,000. But because you're going to have such a great number of investors, you really have to automate this with crowdfunding using software. And so you've got a couple options there, going through an intermediary, you develop your own software, or maybe you take the deal to somebody like Fundrise and partner with them. But the cost for that, I saw again in these statistics from the SEC, on average was like $150,000. So these are costs associated with the offering, and you know, we're all about efficiency. If you're going to be raising $50 million and you have this model in place, it might be a really useful thing, but you have to commit to funding those expenses, you know, to accomplish this little mini IPO.
Great. So I wanted to leave at least 9 or 10 minutes of question and answer time, and we've got just that now. So we'll go ahead and open it up for Q&A.
Hello. Hey. So a lot has been said about social media and what you can and can't say right now. If I'm doing a 506B, the deal has closed, what can or can I not say, maybe during the raise and after it's closed too?
Yeah, this is a really good question, and it's come up recently, and I was talking to somebody here actually, and they said their attorneys told them, no, you can't announce the deal closed. And again, the standard is, you know, it's factual information, so I'm reporting on a past deal, something that's in the past. And I would say as well, I'm assuming you're not still taking in money, the deal's closed, it's fully funded. But the argument is that even though it's a statement of fact, it may condition the market or incite investor interest. And so just that post itself, the deal closed, but you know, it could constitute a general solicitation. And so I guess the bottom line is there's no clear answer about something like that, I don't think. But you just have to consider the risk, because if you were found to have engaged in general solicitation in reliance on you know, you're using 506B, then you've blown the exemption. But I mean, you know, the fact now that you have a website and you can maybe advertise or give information about your history, your past projects, as long as the publicly available information doesn't reflect that, you know, it was you know, we and our partners made this money. It was just we made this money on the deal, and but I would just counsel care, great care.
I'll add a comment to that, because that came up. We had a deal go under contract, and our counsel told us that we could announce that the deal was under contract, but we couldn't have any forward-looking statements. So we couldn't say it's going to be great cash flow and it's going to be you know, a big equity build or anything like that. We couldn't say anything about that. We could simply say we're under contract with the intent of attracting people to help us lease up the facility and be our insurance agent and be our contractor to build the additional space. So it kind of goes by intent. If you're intending to try to condition the market, I think that is a big
Yeah,
pay.
yeah, that's really good.
Next question.
Yes. So if you're raising capital in a 506B with multiple capital raisers, do all of the capital raisers who are bringing in investors need to be named in the LP? If they're receiving fees, they have to, correct?
I would say that if you're disclosing that you're going to engage third-party service providers on terms no more or less favorable than generally available in the marketplace, and you say that you are going to engage, I guess the answer is not necessarily.
Quick question for you. You mentioned something about you have to have an audited financial statement. On what particular specific condition you have to have that?
It's just a balance sheet, and it's if you sell to non-accredited investors. It's a requirement in Rule 502.
Okay. Thank you.
For a 506B
506B.
offering.
So
Yeah, for a
anytime you have
Unaccredited investors.
Unaccredited,
investors,
yeah.
even if they are sophisticated,
Yeah, or they have to be sophisticated.
they have to be
yeah.
to enter in the deal.
Yeah.
Okay, thank you.
Yeah, well, yeah, then it's dated within 120 days of the close of the offering, and then every year it's an annual delivery obligation.
How you doing? Jamie Arnold here. I had a quick question on a REIC for non-for-profits. Is that pretty much the same rules when it comes to raising money for purchasing real estate through that?
For a nonprofit?
Yeah.
Well, so a nonprofit, as I understand it, there's rules about personal inurement, I think is the term. So you can't really have shareholders of a nonprofit that are going to be expecting interest. And then when you have you might have members or contributors or people that are employees. And I guess you could maybe do a public-private partnership as well, but probably for the nonprofit, the fundraising is going to be, you're not selling securities. That's the answer, I guess.
Okay.
Would that make sense?
Yeah, I just have someone who's approached me with, I guess, so for example, New York City has a REIT down there where they're trying to raise capital from people locally and just trying to do more community-type purchases where local people that live there can kind of invest in something that's more community-driven. So that's what they came up with. They did a REIC. And I was just kind of wondering what the policies and processes, if they apply to doing like a Reg A or something like that, or if it's completely different.
Yeah, it would be interesting to see the specifics, but the securities laws apply across the board. So whenever, and this is really an important point, just kind of the basic level, when people ask me about this is, wherever you have a division, it kind of answers the question that when we started out first, a division between ownership and control. And when you really have that with the expectation of profits from the people that are giving up control, you've got a security. And probably there, I guess there's no expectation of profits, so no securities, but there are ways, I think, to create maybe small offerings. And I'm from Austin, and affordability is really a big issue. And I've got a lot of poor artist friends that think about these issues a lot. So I like that notion, and I think that's really my calling, and where I really connect with what I do is democratization of capital. And so, when I think about creating alternative solutions like that, it really inspires me, where it really does give people ownership in this valuable asset here in the United States, but maybe on a smaller scale. And I think generally the SEC is trending in that direction. They understand that the importance of private business in the United States, and giving people a better opportunity to invest in sound investments rather than, again, from the days that I worked at the hedge fund, all those guys that I highly respected, some of the most intelligent people I ever met, they looked at Wall Street as a casino. So that's why I really like working with people in this audience, is because they're creating really what are the best investments available to people. And the SEC, I think, recognizes that private investments need to be made more generally available, not just to accredited investors.
Wall Street to Main Street. Yeah. One more question.
I was told by a securities attorney that there was a limit to how many syndications you could do per year, and he said 6, or you need to get your securities license.
Great question.
Is it the same issuer?
Yes.
One thing that you're going to have is an integration issue. And so like if you close a deal today and then 6 months from now, within 6 months, you have another offering, then they would combine those two and look at them as one offering. But just in terms of like a specific number like that, I'm not aware of any specific limitation like that. There's limits also in the broker-dealer exemption. None, and I know we're about to run out of time, but you can't participate more than once in every like 12 months. So there are some limitations there, but it's 3A4-1 under the broker-dealer rules. The exemption that allows individuals to sell their own securities, individuals that are working for the issuer.
Well, Roland, I learned a ton over the last few months of getting to know you, so thank you very much. Thank you very much for the questions, and if you have any more questions with Roland, he'll be in the back probably during the break, and thank you.